$51.970. That is the new toll booth they just built between you and the silver market. Not for buying silver, not for owning it, for simply holding one futures contract long without getting liquidated. And they didn't debate it on TV. They didn't vote on it in Congress. They just changed the number quietly and dared you to keep playing. If you're staring at a chart right now and thinking silver is at $115, what's the big deal? You're already in the danger zone because the screen price is the paper price. And the paper market only works as long as you believe the paper is the metal. The moment you stop believing that, this becomes a liquidity crisis hiding inside a commodity chart. Now that we've hit the hook, welcome to the Dollar Watch. On this channel, we don't do vibes. We do incentives, balance sheets, and power. And today you're going to see how a single margin update can function like a kill switch, one that turns regular traders into exit liquidity for the same institutions that have been caught manipulating precious metals for decades. Stay with me, because later in this video, I'm going to connect three things most people are not connecting: the COMEX margin spike, the sudden surge in minor month deliveries, and the widening global gap between physical and paper prices. When you see how they lock together, you'll understand why this isn't volatility management. It's triage. Let's start with the document. COMEX announced new silver futures margin requirements effective March 2026. The maintenance margin is $51,977 per contract. Read that slowly. Maintenance margin, not initial margin. Not worst case, maintenance. That's what you have to keep in cash just to keep your position alive. A standard COMEX silver contract represents 5,000 ounces. At $115 per ounce, that's $575,000 of notional exposure, and the exchange is now demanding roughly 9 to 10% of the contract value in cash just to stay in the game. And here's the part you need to feel in your gut. 3 weeks ago, maintenance margin was around $20,000. Then it moved to $25,000. Then $32,500. Now almost $52,000. That is not a normal adjustment. That is a staircase, and the stairs are getting steeper as the price rises. You should be asking the only question that matters in real markets: who benefits? The official narrative is always the same: volatility, prudence, protecting the clearinghouse. They dress it up like fiduciary duty. And yes, clearinghouses are supposed to manage systemic risk. Margin exists for a reason. But when margin policy changes this fast, in one direction, during a squeeze, it stops being risk management and starts being market engineering. It forces one side of the trade to liquidate at the worst possible time. And if you've never traded futures, here's why this matters even if you don't touch COMEX. Futures are the reference price. They're the benchmark the world uses to price silver. When that reference price becomes a controlled narrative rather than honest price discovery, the distortion radiates into ETFs, mining equities, industrial contracts, and ultimately your purchasing power. This is not a niche issue. It's a signal flare. Now I'm going to open a loop that I'll close later. The real story is not that margin went to $52,000. The real story is what they changed underneath the margin system to make sure the pain increases automatically as silver rises. When you see that mechanism, you'll understand why this is designed to remove you from the market, specifically during an upside breakout. Hold that thought. Next, we need to talk about delivery, because paper markets can pretend they're real markets until somebody asks for the thing the paper represents. That's when the math gets ugly. COMEX publishes daily delivery reports, and the January 26, 2026 delivery report is not interesting. It's incriminating. January 2026 is now the 6th largest silver delivery month in COMEX history. 6th largest ever. And January is not even a primary delivery month. The primary delivery months are March, May, July, September, and December. January is supposed to be quiet, an off month where the paper game rolls forward and the physical stays dormant. That's what the system expects. Instead, traders demanded delivery. So far, 9,529 contracts have been delivered with 4 trading days still remaining. Each contract is 5,000 ounces. Do the math. That's tens of millions of ounces moving through an exchange that has spent years conditioning the market to treat delivery as a formality nobody uses. Look at the recent record. March 2025 was the largest month ever at 16,149 contracts. May 2025 came second at 15,122. September 2025 came in at 13,640. December 2025 near 13,000. Now January 2026, an off month, is already beating what used to be meaningful delivery in some primary months with days left. That is a behavioral break. The crowd is doing the one thing the paper system cannot tolerate at scale, asking for metal. And now the name you need to see, JP Morgan Securities. On one day, JP Morgan issued delivery notices for 299 contracts. That's roughly 1.5 million ounces of silver being delivered in a single day. Ask yourself why. Why would a major bullion bank, the same ecosystem that profits from paper volume, suddenly hand over physical? There are only a few reasons an institution delivers physical in size. Either they have metal to spare and want to monetize it, or they are forced, or they are strategically reducing exposure ahead of a larger delivery month. And when you overlay this with what's coming next, March, a primary month, the incentive becomes obvious. If January, the quiet month, is this large, what happens in March when the market is structurally positioned to demand delivery? That's the looming event horizon. That's the third open loop. March is where this either stabilizes or it breaks. And the margin hike effective March is not coincidence. It's pre-positioning. Now let's get brutally honest about the institutions involved. JP Morgan paid $920 million in 2020 for manipulating precious metals markets. That was the largest fine of its kind. That's not ancient history. That's a modern data point. And if you think a fine fixes behavior, you don't understand incentives. A fine is a cost of doing business if the underlying profit engine remains intact. This is why I need you to understand the difference between illegal and impossible. They didn't make it illegal for you to win. They made it mechanically difficult. They turned the game into asymmetric warfare. The exchange can change the collateral rules in real time, while you have to meet those rules with cash you don't have. That's how you get wiped out while being right. To understand how we got here, you need a little history. The modern futures system was built to hedge. Farmers hedged crops. Manufacturers hedged inputs. It was supposed to stabilize real-world production. Over time, it became financialized. Now, most volume is not hedging physical flows. It's leverage. It's basis trades. It's arbitrage. It's high-frequency strategies that treat the underlying commodity like a symbol, not a scarce industrial input. And silver is uniquely vulnerable because it sits at the intersection of two worlds. It's a monetary metal psychologically linked to gold, and it's an industrial metal consumed by technology. That means when inflation expectations rise, silver attracts hard money demand. When industrial demand rises, it attracts real-world scarcity demand. When both rise together, the paper market gets stress-tested, which brings us to the global price gap. On your screen, silver is 115s, COMEX paper, but physical markets are printing different numbers. Shanghai around $130, Tokyo around $140, Dubai around $130, Kuwait around $120, Seoul around $118. Depending on the day and the form factor, you're looking at a $15 to $25 gap between what the paper market claims silver is worth and what buyers are paying for metal they can actually take delivery of. That gap is not a premium. It's a vote of no confidence. It's what happens when counterparties stop trusting the promise and start demanding the asset. Traders have a name for this: the Great Divorce, the separation of paper pricing from physical reality. And here's why you should treat it as a serious macro signal. Commodity markets are supposed to be global, arbitraged, and efficient. If physical is meaningfully higher than paper across multiple hubs, consistently, then either arbitrage is blocked, or the market is refusing to accept paper as a substitute. Neither is healthy. Now I'm going to tell you the part most people miss. Price gaps like this are not just bullish, they are destabilizing. They imply a breakdown in the mechanism that ties futures to spot. That mechanism is the credibility of delivery. Once delivery credibility is questioned, the entire paper complex becomes a confidence game, and confidence games tend to end suddenly. Let's layer in geopolitics, because silver is not trading in a vacuum. China implemented export restrictions starting January 1st. The claim circulating is that 60 to 70% of global refined silver supply is now controlled by 44 state-approved companies. Whether you take the exact percentage as precise or directional, the strategic posture is clear. Beijing is tightening control over refined output and outbound flows. This is not random. We are in an era where commodities are national security, energy transition materials, semiconductors, strategic stockpiles, dual-use industrial capacity. You are watching a world shift from just-in-time globalization to just-in-case nationalism. When that happens, raw materials stop behaving like neutral merchandise and start behaving like leverage. And silver is leverage because it's embedded in the infrastructure of modern life. Solar panels use silver paste. Electric vehicles use silver in power electronics. Smartphones, medical devices, data centers, connectors, relays. Silver is everywhere. Unlike gold, much of silver is consumed. It doesn't neatly pile up in central bank vaults. It disperses into products, then into landfills, then into irrecoverable waste unless the recycling economics change. So when you hear 5 consecutive years of supply deficit, don't treat it as a talking point. Treat it as compounding math. The cumulative deficit since 2019 is described as over 1.3 billion ounces. That would mean the world has been bridging the gap by draining inventories built over decades. And inventories are not infinite. They are a buffer. Buffers are what prevent shortage from becoming crisis. Once the buffer is gone, the price stops being polite. Now look at COMEX vault flows. In the first 2 weeks of January alone, 33.45 million ounces were physically withdrawn from COMEX vaults, about 26% of registered inventory, according to the framing in the source. And since 2020, registered inventory is described as down over 70% from 346 million ounces to under 100 million. Whether the precise inventory accounting matches your preferred dataset or not, the narrative is consistent with what matters. The vaults are draining and delivery demand is accelerating. That's a combustible combination. Quick but important technical point, because this is where the public gets misled. COMEX reports eligible and registered. Eligible is metal that meets exchange standards and is stored in approved vaults, but not pledged for delivery. Registered is the portion explicitly available for delivery against futures contracts. When registered gets thin, you get the exact behavior we're seeing: stress, higher lease rates, backwardation, and margin rule changes that conveniently force longs to back off. Now I'm going to introduce a number that should make you uncomfortable: the paper-to-physical ratio. Analyst claims put the global paper-to-physical ratio near 356 to 1, meaning for every 1 ounce of physical silver, there are 356 ounces of paper claims: futures, options, ETFs, unallocated accounts, derivatives. In other words, most owners are not owners. They're unsecured creditors. They own a promise. And in a calm market, promises trade like assets because nobody calls them. But in a stressed market, the promise gets audited by reality. People ask for delivery, people ask for allocation, people ask for conversion, and the system can't satisfy everybody because it was never designed to. This is exactly how bank runs work. A bank can be solvent on paper and still fail if depositors demand cash faster than the bank can produce it. Futures markets can be liquid on paper and still fail if longs demand metal faster than the exchange can deliver it. Now we get to the so-called kill switch, margin hikes. Mike Maloney and other precious metals analysts have described this playbook for years, and it's not mystical. It's mechanical. Step 1. Large institutions build outsized short exposure over time. Step 2. Price rises and short losses become a problem. Step 3. Margin requirements are increased, forcing leveraged longs to liquidate. Step 4. Forced selling pushes price down. Step 5. Shorts cover into the crash. Step 6. Price stabilizes and resumes upward, but retail and smaller funds are already wiped out. This is not conspiracy. It's a known dynamic in leveraged markets. If you control the collateral rules, you can manufacture forced flows. And forced flows create price moves that look like the market decided, when in reality, the market was cornered. But here's where it gets dangerous for the institutions. This strategy only works if the paper price controls the physical price. It only works if the world accepts COMEX as the truth. And we are watching that assumption fail in real time. If Tokyo is clearing physical at $140 while COMEX prints $115, what does that tell you? It tells you that when delivery matters, the screen becomes negotiable. It tells you that the price is now conditional on the form of settlement, and that is the beginning of a two-tier market. One price for paper promises, another price for metal. Now let's talk about the technical signals that scream shortage, because these are not emotional indicators. These are structural. Silver lease rates have surged to around 8% in the framing you were given. Lease rates are the cost to borrow silver. When lease rates spike, it means someone is willing to pay an unusually high annualized cost to get metal now. That's not something you do in a relaxed market. That's something you do when you have delivery obligations, industrial requirements, or short covering needs that are time sensitive. High lease rates are the market saying physical is scarce and time is expensive. Then there's backwardation. Backwardation is when spot prices trade above futures prices, which flips the normal curve. Normally, futures are higher because of storage, financing, and time value. When spot is higher than futures, the market is essentially shouting, "We want it now." Immediate demand outweighs carrying costs. Backwardation in precious metals is not supposed to be common or persistent. When it shows up, it tends to show up near stress. Now I'm going to give you a quick pattern interrupt, because this is where you might be tempted to mentally check out. You're thinking, okay, margin, delivery, lease rates, how does this hit me? Here's how. If you're holding paper exposure, ETFs, unallocated accounts, derivatives, you are relying on counterparties behaving. You are relying on redemption mechanisms functioning. You are relying on the system not changing the rules, and the system is changing the rules in front of you. Back to the core issue. Who gets hurt by a $52,000 maintenance margin? Not the banks, not the biggest funds, not the clearing members with deep credit lines. You, smaller traders, smaller commodity funds, anyone trading with leverage, anyone who was right on direction but not rich enough to survive collateral shocks. Now remember the open loop I promised to close about what changed underneath the margin system. This is where the design becomes obvious. As of January 13th, COMEX moved toward percentage-based margins rather than fixed dollar amounts. Silver is now set around 9% of contract value. That sounds fair until you understand the implications. In a rising market, your required margin increases automatically. Every new high forces you to post more cash just to keep the same position. That means the better your trade performs, the more likely you are to be forced out if you don't have deep liquidity. That is the opposite of how a free market is supposed to reward correct positioning. It's a built-in brake on upside participation for anyone who isn't institutionally funded. And that mechanism is why the margin hikes feel like they're chasing the price. They are. It's automatic. It's self-reinforcing. It turns a bull market into a treadmill where you have to keep paying just to keep running. Now let's talk about the behavior shift that makes this truly alarming. Traders rolling backward. In normal futures behavior, traders roll forward. They close near-month contracts and open later-month contracts to maintain exposure without taking delivery. That's the paper game. But if traders start migrating from March contracts into January or February, they're pulling delivery forward. They're accelerating settlement timelines. That only makes sense if they want metal now, or they don't trust that metal will be accessible later. This is a red flag for any exchange that depends on confidence. Because if enough participants stop rolling and start demanding delivery, the exchange faces a hard constraint: inventory. And that brings us to the part nobody wants to say out loud: force majeure. Force majeure is when an exchange or a contract mechanism admits it can't perform under the stated terms and settles in cash or changes conditions. If a market built on deliverability starts settling in cash as a workaround, the price is no longer a price, it's a settlement suggestion. And when that happens, global physical markets decouple permanently. Now, I want to address the skeptics directly, because skepticism is healthy. You should distrust anyone selling certainty. There are three types of people watching right now. One, you already own silver, and you've watched paper games smash the price before. Two, you're curious, but not committed. Three, you think this is all exaggerated, and you believe markets are basically fair. If you're in group three, I'm not asking you to join a tribe. I'm asking you to look at incentives and documented history. Markets are not moral. They are governed by rules. And the people who can change rules can change outcomes. Let's go back to 1980, because that's the historical rhyme everyone keeps referencing for a reason. The Hunt brothers accumulated silver aggressively. The market spiked, and then the exchange changed the rules, most famously moving to liquidation-only conditions, raising margins, and choking off the ability to buy. The price collapsed. The Hunts were destroyed. Now you might say, good, they tried to corner the market. Fine, debate the ethics, but the structural lesson is what matters. When the exchange perceives existential risk, it will intervene in the mechanics. It will not remain neutral. It will protect the system as it defines it, even if that means crushing participants. That is why the $52,000 number matters. It is not just a price, it is a governance action. Now let's add another data point from outside the US, because some of you still believe this can't happen here. 3 weeks ago in India, specifically Rajkot, a major silver trading hub, 44 trading firms reportedly declared bankruptcy in a single week, with losses around $425 million. These were not random retail gamblers. These were professional operators. They were profitable until the rules and margins changed. Prices snapped, and liquidity vanished. They couldn't meet margin calls. They were wiped out in hours. That is what leverage does in a rule-changing environment. It turns time into a weapon. Now, we need to zoom out to the monetary context, because silver doesn't exist in isolation. Gold just printed an all-time high, around $5,279 per ounce, in your source framing. And it happened right as political leadership publicly insisted the dollar is doing great. If you want to understand real markets, watch what they do when politicians speak. When leaders talk up currency strength and the market buys gold the same day, that's the market issuing a verdict. Gold is the anti-spin asset. It is what people buy when they don't trust narratives. And this brings us to the deeper, darker macro truth. Every fiat system is a confidence system. The US dollar is not backed by gold. It is backed by US taxation capacity, US military reach, and the network effect of global trade settlement. That system has survived because the United States has been the center of global liquidity for decades. But we're now in an era of rising sovereign debt, persistent deficits, geopolitical fragmentation, and weaponized finance, sanctions, export controls, reserve seizures. When you weaponize the system, other players build alternatives. That's not ideology, that's survival. Silver rides that wave because it's both monetary psychology and industrial necessity. Historically, silver follows gold, often with more volatility. And by historical ratios, silver has frequently lagged before catching up violently. That's why institutions fear a disorderly repricing. It doesn't just create winners, it reveals leverage, shorts, and hidden balance sheet fragility. Now we're at the point in the video where I'm going to be very precise about what happens next, because you deserve clarity, not theater. There are only a few realistic endgames here. One outcome is that paper prices rise to meet physical. That would mean COMEX and related paper instruments are forced upward by sustained delivery pressure, industrial demand, and global arbitrage. In that world, silver spikes, shorts scramble, and some institutions take meaningful losses. You would see volatility that breaks models and triggers emergency margin hikes, exactly what we're already seeing. The other outcome is that physical markets abandon COMEX pricing. In that world, you get a permanent two-tier system. Paper trades at one price because it's easy to settle and it's abundant. Physical trades at another price because it's scarce and it's demanded. This is the great divorce becoming policy, not just a market condition. Either way, the center of gravity shifts away from the paper screen and toward the ability to deliver. And once delivery becomes the benchmark, leverage becomes poison. Now, before I tell you the one move that this $52,000 trap cannot touch, I need you to understand the psychology they are counting on. They are counting on you needing immediacy. They are counting on you wanting action, leverage, and speed. Futures are seductive because they make you feel like you can control $575,000 worth of silver with a fraction of that in cash. But that control is conditional. It exists only as long as the exchange allows it at those margin levels. When the exchange raises margin from $20,000 to $52,000 in weeks, it's telling you something without saying it. We are not comfortable with the risk profile of this market. And if the exchange is uncomfortable, you should be terrified, because you are the least protected participant in the hierarchy. Now I'm going to close the loop. The move their margin trap cannot touch is simple, and that's why it's so offensive to the system. Physical ownership without leverage. Physical silver does not receive a margin call. Physical silver does not get liquidated because a committee in Chicago or New York decided volatility is inconvenient. Physical silver does not depend on a clearing member's credit line. It has no counterparty risk. It sits outside the paper complex. That doesn't mean it's risk-free. Price can fall. Premiums can compress. Storage and security matter. Liquidity is different, but it means the mechanism of forced liquidation, the kill switch, can't reach it. And that is exactly why physical premiums are exploding across global hubs. People are paying up to get out of the promise and into the asset. Now, I'm not telling you what to buy. This is not financial advice. I'm telling you what the system is telling you through its actions. When margins spike, when delivery surges in off months, when lease rates jump, when backwardation appears, and when physical diverges globally, the system is signaling stress. And when systems are stressed, they don't protect you. They protect themselves. So here's what I want you to do with this information practically. First, stop treating a chart as reality. A chart is a settlement narrative inside a leverage structure. Second, audit your own exposure. If your silver is an ETF or an unallocated claim, understand what you actually own. A promise, not a bar. Third, if you insist on trading paper, respect the collateral risk more than the directional call. Being right is meaningless if you can be liquidated by rule changes. Fourth, watch March. Watch it like you'd watch a bank's quarterly funding window, because March is when delivery stress either cools or becomes undeniable. And here's the final open loop I'll leave you with, because it's the question that matters more than any price target. If the market is already paying $140 in Tokyo for physical, while the screen prints $115, what happens the day a large pool of paper holders decides the promise isn't enough? That's the day the price becomes whatever metal clears at. And that's not a prediction. That's how shortages work. If this video helped you see the machinery, not the headlines, subscribe to the Dollar Watch. We track the hidden plumbing of markets, the collateral changes, the delivery reports, the geopolitical supply chains, and the institutional incentives that decide whether you win or get harvested. And remember the numbers, because they're the simplest lie detector you'll ever get in finance. $140 in Tokyo, $132 in Shanghai, $130 in Dubai, and $115 on your screen. That gap is not noise. It's the truth leaking through the paper.